recording.
Good evening, all.
Good evening, ma'am.
Yes. So, can we wait for say a few more seconds so that we can let 2-3 more participants join the session, then we can start, right? So we can wait for hardly 1 to 2 minutes more, and then we can start. Okay, then. So we can start the session. Hope the presentation is visible. My voice is audible as well.
Yes, ma'am.
Yeah. Okay. Fine. Yes. In our last session, we were discussing about this seed funding and few more topics, right? Okay. The difference between venture capitalist and the guys, please mute your audio.
Recharge app to make calls. Please recharge immediately.
Mr. Justin, please mute your audio. Make sure you are muting your audio, okay? Whoever is joining the session. Okay, so in our last sessions, we were seeing about the angel investors and these venture capitalists. So what is the difference between these two, parties who are angel investors and who are venture capitalists? And what is the main differentiation? And what are the advantages and disadvantages of, uh, making use of a venture capitalist to fund for your business. And then we were seeing about the seed funding. So there are 3 stages of seed funding. The first one is seeding. That is the basic funding stage. So at the initial start of the business, these investors, they fund your the business. I mean, to give you a break. So they fund, and next is the Series A funding. So by now the business would have developed to some extent. So to move on with more operations, to move on with more marketing activities and everything. to little expand your business. That is not like to outreach to more customers. So you have to know like invest more in branding, advertising, marketing, and everything. So for that reason, you have no like asking the investors again, that may be the same investor, whether it's angel investor or a venture capitalist, whoever it is, you're asking them to fund you more. So they are no like doing it based on the performance, based on your organization's performance to boost up your business. This is Series A funding. And then comes a Series B funding where now you're expanding your business. It is not like you're outreaching to the global customers. You're trying to reach out to the global customers. So you require more fund for that. That's why you're no like asking no like more funds, more funds, asking them to pump in more funds for your business, and they are doing it. So this is how the seed funding is done. The funding stages, like there are 3 stages. So seeding, Series A funding, and then Series B funding. Okay, so mostly it is done by the venture capitalist. The main difference between angel investors and the venture capitalist is angel investors mostly they don't go for Series A and Series B funding. They invest in the beginning stage of the organization. That is when the organization is born. They they give you a helping hand. So there, all they expect is the returns after sometimes. They require their share in their equity and everything. So that is what they are expecting from the organization as returns. Whereas venture capitalists are those people or those industrialists who will be funding for your organizations in at different stages in your business. And then we saw about um, strategies. Yeah, strategies like for a Series A funding and Series B funding, and the difference between Series A and Series B funding. Okay. Now, I think we have stopped till here. Okay. Now, there are many challenges in securing seed funding. So imagine, you're in the verge of starting a business, and you want them to fund. That is, you need the funding at different stages of your business, not just in one particular stage, not in the starting stage, but in different stages of your business. So in that case, you have to convince the investors to fund accordingly. This funding you may be requiring at any time in the business. It is it is not a fixed period. You're not giving them the fixed period that, okay, so say by 2025 January, I'm going to start a business. So I need seeding fund for that. And by 2027 January, I'm going for Series A funding. And by 2029 January, I'm going for Series B funding. No, it's not like that. Any time, once you have started off your business, any time during the, the business life, you may be requiring more funds, to expand your business, to reach out to more customers, to open a new plant. That is to open a new office, like in somewhere in another location. So either you fix up the time, date, and everything, and know the reason for the funding, and you inform them, they agree to that, or you have to convince them that anytime you would be requiring this funding. So they have to be, those investors have to be ready to be ready to fund for your business whenever you are asking them. So since there is this is going to be funding again and again, that is at least for 2 to 3 times, there is high competition. See, if I am having, consider me as an angel investor. So I am planning to invest, 1 crore in some business startup. So I'm just identifying a good business person, an excellent entrepreneur who is having excellent idea of starting a business. And I'm seeing the future of the business. There is I'm damn sure that this business is going to give some profits after some time. So I'm now investing on the initial stage as an angel investor. In the initial stage, I invest maybe, like 50 lakhs to 1 crore. I'm like ready to like invest. And like that's it. What I require back is share in the equity to be part of the company. And the exit policy is clearly mentioned to me either by myself or by the entrepreneur. So at the stage of exit, wherever the exit strategy, like comes, there is like wherever there is like that time for exit, I'm exiting from the business, taking off the profit, taking off the percentage of investment, whatever I have invested in the business. So my role as an angel investor is done. But if I am planning to invest 1 crore as like as a venture capitalist, so that scenario would be like completely different. So anytime the entrepreneur will be like asking me for funding for the business, again and again, not in one particular stages, but in different stages at different times, like it may like the person may be requiring, and because of that, like I too like I have to face some risk, because when I am an angel investor, like I'm quite sure, at least 80 to 85% sure that this investment is going to give me some returns after 3 years, 5 years. But as a venture capitalist, like I'm not so sure about it, because only after my second investment, that is like only after I have uh, again invested like in the business, so then I'll be knowing to what extent the business is going. So that is how it works. So as a venture capitalist, like I'm always in a a little dilemma of like whether to invest or not, whether to invest more or not. So whether to invest in one particular business or go on investing in like 2, 3 businesses. So like I'll be with that 1 crore, I may be expecting like to invest in 2, 3 businesses, like putting forward by like at least 2, 3 entrepreneurs. So why should I invest in only one business? So why don't I go for like 2, 3 businesses? So this would be my thought. So since that is like this is how the like the venture capitalist will like think about. So because of this, there will be high competition. So securing seed funding involves intense competition, as many startups are vying for limited resources. Then is proof of concept. Startups often struggle to demonstrate a viable proof of concept to attract seed investors. There is like you have to like show the proof that like this idea would work out. This business idea was going to like reach something like so big. So there should be a strong proof of concept. The business plan itself, like it should be very strong, so that like it attracts that venture capitalist, like into the business stream. So I should be like as a venture capitalist, I should be voluntarily like coming up for investing in your business. So that is how it works. So such should be the business plan. And then is risk perception. Investors may perceive startups at the seed stage to be riskier investment. See, that is what I mentioned. So this is little bit risk. Comparatively, if you look on to like if you compare angel investing and like venture capitalist investing. Angel investing is like little much better than like venture capitalist. Because like in angel investing, like you couldn't find that much risk, because you're like at most 85 to 90% you're sure this business idea is going to work out, and you have the clear exit policy already discussed between yourself as an investor and between the entrepreneur. So you know very well when to quit the company, when to quit the business, and know like what percentage you're going to take from the business. So it's damn very clear. You don't have to like worry about, there is no risk involved in it. But like in as a venture capitalist, that the scenario is like completely different. There is like there is some riskier scenario happening. So investors may perceive startups at the seed stage to be riskier investments, leading to funding challenges. And then is network access. Accessing the right networks and connections for seed funding can be a significant obstacle for startups. Imagine like you're depending as an investor, you're depending on a venture capitalist. So that capitalist agreeing to fund for your business at different stages. So initial seeding, yes, that person is no like giving to you. He's like that person is no like offering to you. So you're starting off your business, and at the second stage, no, when you're trying to know reach out more customers, no, go with more products, go with more branding and advertising. So you're asking more the person to know like fund you more. That is fund more for the business. And by this time, that no, like that person, the venture capitalist, and no, like telling, no, like there is no enough funds. So consider your situation. So how you will be, because no, like already, no, like the business is half done. All you need is no, like a little more investment so that no, you can boost up your business. But the person who was no, who was ready to invest, no, in the initial stage, now maybe no, like that person has lost interest in your business anymore, or no, like maybe to be no like maybe the fact maybe no like the person is not having enough funds. So it's always no like riskier for both the venture capitalist as well as for the entrepreneur. So since this is not like happening, you have to know like consider many things before approaching the venture capitalist. It is good because at different stages in your no like business, you may be require funding, and no like it's good to know approach venture capitalist. But if you compare angel investors and venture capitalists, so angel investors no they score more in this run in this business run. So next is, so what do we know, like get to know about no like venture capitalists finally? So whether to go for them or no like whether to select the angel investors instead of venture capitalists. So even if you are choosing a venture capitalist, no like how things are going to work out. So you're an entrepreneur, you are no like approaching a venture capitalist, and talks has been finalized, and no like then what? How you're going to deal with the person, and how you're going to deal with the business. What are all the other no like precautionary measures no you can take from your side? So what do we learn from these venture cap? Each funding stage presents unique challenges and opportunities. Successful navigation requires strategic planning and adaptability. So then is continual evaluation. The entrepreneur, that is the business owners, must continuously assess their business needs and goals. Understanding the investment landscape is essential for informed decisions. So, like few things would have been agreed upon by the entrepreneur as well as the venture capitalist. But if at all in case it is necessary for the business, few plans can be changed, few decision plan, few no like already taken decisions, it can be no like changed. That's fine, because no it's good for the business. Since it is good for the business, it's good for the entrepreneur as well as it's good for the investor as well. So no like what this is done only when the no where there's a continual evaluation about the business, continual evaluation about the investment. So this evaluation has to be done by both the parties, by venture capitalists as well as the business people. Then is building relationships, forming strong connections with investors is vital for long-term growth, and trust and open communication are foundational to fruitful partnerships. So this trust, credibility, genuinity, and no like integrity, business integrity. So it is always no like mentioned in any kind of investment, any type of investment. This is applicable for no angel investors, angel investing, and this is applicable for seed funding, and this is applicable for venture capitalists. For any business, when you're into partnership, when you're no expecting no like other person or other agency, an external agency to fund for your business, that should be transparency. So if you're trying to hide something, no like things may no like take a wrong turn. So always maintain transparency. So and no like be very trustful with each other, have a very open communication, whatever it is, no like this open communication is a must between these two parties. Okay. So we have seen angel investors and we have seen no like venture capitalists. Now we are going to discuss about high net worth individuals. So how these people are different from the other two? Let's see. High net worth individuals. So shortly they are now like called as HNWIs. Refer to people with substantial financial assets, typically in excess of $1 million. That is no like at least no as per no like the Indian money, no like at least they should be having a turnover of no like liquid assets. So what we speak here is about the liquid assets, not all the assets. That is immediately cashable assets. So it should be at least 10 crores and above. So those people are called as high net worth individuals. These individuals require specialized financial services and have unique investment priorities. And remember, these high net worth individuals, like they don't have to have a business. They don't have to run a business on their own. They don't have to like prove themselves as a successful entrepreneurs, in their in their platform. No, it can be any person, who is having this much worth of money. It can be anyone. See, I can be say a homemaker, but my net worth is say at least my like my assets the liquid the cashable assets so it is of minimum of 10 crores and above. So I'm planning to invest. I'm a high net worth individual. I don't have to run a business. I don't have to prove myself as a a successful business person. I don't have to know about the industry. Nothing. I don't have to know about what business is. All I want is I want to know invest. So I have excess money. So I instead of keeping the money idle, I want to invest in something which can give me good returns. So these are high net worth individuals. That is whose financial assets, especially cashable assets, liquid assets. So if it is exceeding more than $1 million. So if you take like India, so whichever person it is, whoever is the investor, if that investors turnover, there is the annual turnover, sorry, not annual turnover. So like their net worth is liquid cashable assets is of minimum 10 crores and above. Yes, they are considered as, they are termed as high net worth individuals. So definition and criteria for high net worth individuals. Asset threshold. They are often defined by the value of their investable assets, excluding their primary residence and consumables. So that's why I mentioned like cashable assets, which can be immediately liquefied. Immediately, it can be like made as a cash, not the fixed one. So that is the asset threshold. Income level. Typically, a certain annual income level is used to classify an individual as an HNWI. So their income level on a like a monthly basis or annually, like how much they are they are getting as an income. They are making as an income through any sources. It doesn't have to be from some business. It doesn't have to be some business at all. They might have invested in a bank and like the bank is giving them like an interest kind of a thing, paying us whatever for investing in their bank. So that is also considered as like an income. Or this person this HNWI person has built a biggest a big mall or something like a big infrastructure and collecting rent out of it. The rent itself is exceeding like 10 crores and above. So this person is ready to invest that into like any business, promising business. So this person is high net worth individual. So it can be any person, and this income level like there is a standard, and there is no need this income should be from some other business. A net worth calculation. Various factors, including investments and property ownership, contribute to determining an individual's net worth. So, ultra rich, so here is the, pyramid, like depiction of like who is a high net worth individual and very high net worth individual, ultra high net worth and no billion. Okay, so high net worth individual who can generate money between 1 to 5 million, and very high net worth individual is who can their income level is between 5 to 30 million. Ultra high net worth individuals, no, they can make 30 to 999 million and more than that. And billionaire, we all very know, yes, minimum, no, like 1 billion and above. So if they can make up that money, if their income level is no like more than 1 billion, they are the billionaires. So this is the criteria for high net worth individuals. So here is the like an easy depiction of the difference between like all these three: high net worth, very high net worth, ultra high net worth. So high net worth individuals are generally defined as those that have a minimum of US dollars 1 million in financial assets once the value of their primary residence has been discounted. That is, their fixed assets is not taken into consideration. Then, very high net worth individuals, people with a net worth of US dollars 5 million or more, are classified as very high net worth individuals. And ultra high net worth individuals, people who have either a disposable income in excess of US dollars 20 million or liquid financial assets exceeding US dollars 30 million in value, or known as ultra high net worth individual. So that is the difference. So all it matters is money, nothing more. Can be any person, it can be anyone in the world, or belong to any country. Nothing matters at all, doesn't matter at all. So it depends upon the income level and the person's interest to invest in the business. And note this point. So this person is investing in the business and not in any other factor. Say if the person is having an income level of 1 million US dollars and more, and the person is investing in share market, in commodity market, or in banks FD or recurring deposit, whatever, that person is not considered as high net worth individual. That person is investing some money out from his income or her income in a business, not his or her own business, but on others' business idea, especially startups. Then that person is considered as high net worth individuals. So global distribution of high net worth individuals. Where are these people? Concentration in urban centers. So of course, mostly in urban centers, you can see this, HNWIs. Major cities across the globe, such as New York, London, Tokyo, host significant numbers of HNWIs. And then emerging economies, the growth of HNWIs is notable in emerging economies like China, India, and Brazil. And how many high net worth individuals are there in India? So as per 2023, there are around 35 lakhs of high net worth individuals. 35 lakhs who have income level of a minimum, I think 10 crore and above. So 10 crore and above, and they are investing in other businesses. So it's a growing economy, like China, India, Brazil, and all. It's a growing economy. So that is the reach of these high net worth individuals in India. There is they have started investing, especially between 2018 to 2023. And during the COVID time, many people these high net worth individuals they were not having any options to invest. because no, like everything was shut down, nothing was no like working, and they were simply having the cash with them, they were simply having the money with them, and it was ideally no like ideally it was no ideally it was with them. There was no returns coming out of that. It was money was not doubling, it was not tripling, no like it was just no like lying as it is. So that's when no like they decided, okay, so why don't we invest in no like other businesses? So from between 2018 to 2023, the number of high net worth individuals no so it has been drastically increased, the number of investors. So billionaires. So we have seen about no like ultra high net worth individuals, very high net worth individuals, and then billionaires. So India has no like around 16 no like lakhs of billionaires. 16 lakhs of billionaires. That's what no like the the study says. It has around 16 lakhs of billionaires. But where are these billionaires? Are they all concentrated in no like urban cities? No. Only a portion of them are in urban cities, and no like the remaining people, no like either they are NRI or they are in no like rural areas, especially no like people who are no like investing in land, and no like they are investing in agriculture, or they are investing in no like some other no like high income yielding businesses, sometimes even in share markets, no like they are investing in share markets and they are getting good returns out of it. But that person may be no somewhere no like it will be no like in some remote village in India, somewhere in northern India. So such is a scenario. And in 2023, no like at least 13,000 high net worth individuals are there. 13,000. So their no like income level is no like a minimum of 30 million US dollars and more. So no like you're no like you're far no like more what do you say no like you're far more than no like doing better than no other countries, especially no like better than UK when it comes to investing in businesses. And then regional preferences. These high net worth individuals often concentrate in regions known for financial infrastructure and favorable business environments. Okay, so how do they plan their wealth? Whether do they invest in one investment option or do they go for hedging? So hedging, we already know what this hedging is. Instead of investing in one business, that is in one factor, you are dividing the investment money into like 3-4 parts, and you're investing in different investment factors. So why this is done? To minimize the risk. Even if one doesn't work out, the other investments will save you. So that is the reason, no, like you're going for hedging. Okay. So what these high net worth individuals do for no like planning their wealth. See, we will be planning for no like say next 5 years, 10 years, no like till our children no like get married and till our retirement life. But these high net worth individuals, they plan for next 40, 50 years. So they even plan, no, like, okay, after my death, after, no, like, I am gone, so where my money should go. They even plan for that. So to which investments, no, the money should go. A portion of it goes to some charity, they decide on that. And a portion of, no, like, it goes to my, no, like, closed ones. A portion of it goes to my, no, like, offsprings. A portion of it goes to my like other businesses and everything, because even after their death they want their businesses, they want their name to be like sustained in the the business environment for quite a long time. They want that sustainability factor, so they plan accordingly, like they beautifully have a plan about their investment and everything for the next 50 to 60 years, not just for next 15 or 10 years. They don't plan for it. Normal people know, like me, so they will plan for it, no, like in another 10 years, in another 15 years, no, like till my like children like grow up. So this will be my like financial planning, or till my like during in my retirement age, this will be my plan. But these high net worth individuals, they plan for next 50 to 60 years, even sometimes even more than that. So common investment strategies of high net worth individuals. How do they plan? The first one is diversification. So obviously, because if any person, let it be like high net worth individuals, or let it be angel investors, or let it be venture capitalists, so the normal person like you and me. So only if we go for like hedging, that is like only if we choose different investment options, our future is safe. Or otherwise, if you're investing all your hard-earned money in one business, just one business, whether it be share market, or whether it is like land or building, or whether it is like gold, or whatever it is, like that's not going to work. So you should always go for hedging. So divide your investment into like 3 to 4 parts, maximum 4 parts, and invest in different investment options. This is to reduce risk. And now, not only that, this gives more returns as well. Instead of investing in one single factor, one single investment, if you are dividing your money into investing in like different investment factors, you will be reaping more. And these high net worth individuals do the same thing. They go for diversification. So these people explore diverse investment avenues to minimize risk and optimize returns. Stocks. Investing in high potential stocks aligns with high net worth individuals' long term wealth accumulation goals. Stocks. Okay, so what do you understand by stocks? Stocks is not just the like shares of the company. No, it doesn't mean only that. So stocks refers to many things. Many things. So I can invest in like I can consider AI as a stock, because like I feel AI is going to like rule the world like in another 5 years, and it's going to give excellent results. Robotics, AI. So this thing is going to like rule the world. So without these two, like the world is it's difficult for the like people to like survive. So if I believe in that, yes, almost like to 60-70%, no, that's the fact. That is the truth actually. So I'm going to invest in like AI and robotics. So for me, this AI and robotics is a stock. Stock doesn't mean like only the shares of the company. So stock is like many things for me. So gold prices are rising up. So it's like speculated that like by 2000, like 30 or 2000, not even 30. So by 2000, like 27, the gold price will like reach up to 8 grams of gold price. No, it will reach up to 1.25 lakhs Indian money. That is a speculation, like, yes, obviously, like for me, then, like if I'm planning to invest in gold, so gold is my stock. So stock, it doesn't have to be always a share of the company, the share value of a company. The stocks can be anything. And if like Elon Musk like comes with like some investment option, like where he is asking to invest in this like rocket, or invest in this like plan to like to settle down in Mars. If I see like a great opportunity in that, so I consider that as a stock I start investing in. So growth stocks, these HNWIs, they investing in high potential stocks aligns with these people's long-term wealth accumulation goals. See, that is why they are planning for next 50 to 60 years. So they invest in like long-term stocks. They know what is going to rule the world, what is going to happen in another 30, 40 years, which economy is going to like grow up. India may be now like a developing economy, but like many investors have speculated, like investors all over the world have speculated that by 2043, 2043. By 2043, so India will be, like highest in the economy. India will be the first in the economy. Economically, like almost equivalent to US. So they started investing in, like in India more. Now India is, like seeing lot of investments, like receiving lot of investments, from, like many foreign direct investments from many, like venture capitalists all over the world. They have started investing here. They have started investing in China as well because they see that, these two economy, like they are going to boost up somewhere. So for them, India, China is the stock. They can invest in anything in India. They can invest in the infrastructure, they can invest in the people, they can invest in the banking sector of India, or they can invest in the, like infrastructure of China, whatever it is, like because for them it's a stock. And these HNWIs go for alternative investments. These people consider alternative assets such as real estate, private equity, hedge funds to enhance their portfolios. So here is the, like a pictorial, like depiction of, like how these high net worth individuals, like plan their investments. See, equities they have invested, like a maximum, like approximately 30%. Cash and equivalents, like approximately 24%. Fixed income, they have invested in fixed income so that, like they gain a fixed income month on month or, like on an early basis. It is, like approximately 18%. In real estate, they have invested approximately 15%, and alternative investments, maybe, like share market, commodity market, or whatever it is, like they have invested in 14.2%. So this is how, and it depends on, each HNWIs. This is not the fixed investment plan for all the HNWIs, but, like it depends on the people. So whichever, like they want to invest more, they can go for. Challenges and opportunities in serving high net worth individuals. So you have, like convinced a high net worth individual to invest for your business. So what would be the challenges and opportunities, you will face as an entrepreneur? Complex service needs. So these people, these high net worth individuals, they require sophisticated wealth management and tailored financial planning services. So your business plan should be, like so sophisticated. Sophisticated in the sense, like it should show something, like some quantitative, like return options, quantitative return options. Not just in words, but, like it should be quantifiable. Something so sophisticated. They require more sophisticated, like lifestyle. So for that, like they require more sophisticated investment. And that's why they need more sophisticated business plan. So you should be ready to, show that sophistication, in your business plan, in the way you speak, in the way you convince them, and in the business idea itself, like we have to show that sophistication. And trust and confidentiality. Building strong relationships based on trust and discretion is crucial for financial advisors serving HNWIs. Again, trust, comes here. Nowhere, like it says, like you can take decision on your own, even if you're, like even if other person is investing business, it's your business, so you can take your own decisions. You don't have to, like be transparent with, like these investors and everything. No, there is no such point, like mentioned in any of the business plans, any of the investment plans. So trust, confidentiality, integrity, is mandatory. So especially when you're, like asking other people to invest for your business. Innovation and customization. So since sophistication is the mandatory part in convincing these HNWIs, so innovation and customization also becomes mandatory. Opportunities lie in customizing financial solutions and staying abreast of evolving market trends for HNWIs. You cannot just like convince them with your business plan alone. You have to demonstrate how it is going to work. So you have to show them what are all the opportunities, like it's like lying before them, the growth opportunities of your business and how it can be quantifiable. So there is more challenges when you're like if you have got a high net worth individual, to convince them to like invest in your business. But like it's a golden catch. If you have got a high net worth individual, it's a golden catch. Because they will be ready to invest like any such amount and any time you're asking for it. If they have believed in your business, if they have like believed in you, then they will be like ready to invest. Whenever you're asking for money, they will invest for you. So what are all the trends and insights? First one is ethical investing. Increasing interest in ethical and sustainable investing aligns with the values of many high net worth individuals. Technology adoption. Since they always look for sophistication, they will be ready to adapt to any technology which gives them that sophistication. So you have to add more technology related factors, technology factors in your business. So digital platforms and innovative financial technology cater to the preferences of tech-savvy HNWIs. The third one is impact of generational wealth transfer. Anticipated wealth transfer between generations sparks new strategies for wealth preservation and legacy management. See, that is what they plan. So they transfer their wealth for their future generations. They even plan for their future generation. They just don't plan for themselves and their like offsprings. They don't stop with that. They plan for like future for the next third, fourth generation as well. So that's why they think for next 50 to 60 years and even more than that. So key considerations for financial planning for high net worth individuals. So what are all the key considerations? So global portfolio diversification. You have to show them the global portfolio. There is no how your business is going to like go globally. How your business portfolio will be looked by other people like who are in other parts of the globe. And how you are going to show up the diversification in your product, in your service, in your business plans, in your ideas, in the technology, in the innovation part, in investment, in everything, in all the factors, how you're going to show the diversification. And next is asset protection strategies. So convince them and like create a trust like with them. There is like they have to trust you. They have to trust you so that like you have to give them the idea how to safeguard their asset. Asset in the sense, not all the assets they are having, but the asset what they are ready to invest for you. So how you are going to safeguard it? Maybe you are going to multiply it. You're going to give returns out of it. So asset protection strategies, like show the strategies, like quantifiable strategies. Not some gimmicks, but quantifiable strategies, showing them that like this is definitely going to work. So which makes them convinced that okay, their assets will be safe. Whatever they have invested, so that would be in the safer hands. The third one is estate planning and wealth transfer. So these high net worth individuals, they want you to like plan for the wealth along with them. That is the difference between angel investors, venture capitalists, and high net worth individuals. So once you get like acquainted with these high net worth individuals, you will start thinking like them. You will become one of them. You will also be like planning to like invest and like you will be like doing all the plans for next 50 to 60 years and more than that. You will not stop the planning, your business plan or your professional personal plan, you will not know like confine it to next 15 to 25 years. No, you will plan for no like more than 50 years. So that is how no you will become. If you have got a no like a high net worth individual to invest in your business, again, no like you have got a golden catch. It's an excellent opportunity for you. So how should be the business plans no for these three types of people? We have seen angel investors, we have seen venture capitalists, and we have seen this high net worth individuals. Should the same business plan be applicable for all these three? Definitely no, it should be changed because the investment option is different between no like these three parties. Angel investors, they mostly go for investment for one time only. That is during the start of your business, the initial stage of the business, not after that. No, definitely no. Like in most cases, angel investors no like don't invest again. No, like you cannot ask them no like ask them to fund for your business more. Mostly it would be no like one time investment. So your business plan should be like aligned and like edited and like beautifully like uh, shown up according to that. So next is the venture capitalist who would be investing for your business like in different stages. So you have to show them the clear business plan when you're going to start the business and when this business like will reach the growth stage and how much money is required during that time of the growth stage and approximate calculation of the money, approximate value, how much is going to require for like capturing new market or for like going for heavy advertising or for like marketing the product or for giving out the free samples of the product to like some group of customers and asking them to try it and give a feedback about it. For any reason, you require more funds, after some time to boost up your business, to speed up your business. So that should be clearly mentioned in the business plan. And then finally, these high net worth individuals. So this is like little tricky and like you need lot of patience while you're working with high net worth individuals because they always plan their investment. That is whatever they have invested in your business. So all the plans, they will sit with you and plan everything. So you will be a co-planner in this situation. With angel investors, like you don't have to like sit with them all the time, whenever you're like planning for something. But you have to be like trustful. You have to like inform them what you are planning for. That is fine. But no, you are not going to sit along with them, and like work out the remaining business plan. And for venture capitalists, no, not same. Like it applies the same. You don't have to do that. But with high net worth individuals, they will plan along with you. They will plan their assets along with you. They will plan their asset protection strategies along with you. Or if you are doing the strategy, like if you are planning for them, you have to like sit along with them and do the planning. That is what they expect from you. After some time, like after having a good business relationship with these high net worth individuals, so you will become one among them. One among them in the sense, like it's not sure that you will be also be like earning 30 million per year or whatever it is, not $30 million per year. No, that is not the context I'm speaking about. But no, the planning part, the financial planning part, the investment planning part, the asset planning part, you will just think, you will start thinking like a high net worth individual, and that will take you to higher places in your business, and that will make you as a high net worth individual, those investment plans, because they have made those plans, and that's why they are high net worth individuals. So if you are going to follow the same, no, you will also become one after some time. Whether you like it or not, whether it's no like consciously or not, you will become like them after some time. So we have seen, no, like these three parties, three basic main investors. We have still more. We have no these accelerators, Y coordinators, crowdfunding, and these three are also no like the part of those startup equity. And so let's discuss about these these three factors, these people in our next session. So if you have any doubt, you can stay back or you can leave the session. We will meet next week.
Thank you.